Everyone, good evening. This is Joe Fairless, co-founder of Ashcroft Capital, and I'm with Frank Rossler, co-founder of Ashcroft. Grateful for our partnership on Westmoor, and the purpose of this conversation is to give you a detailed update on operations, as well as provide an update on the capital event status. We know we're coming up on 5-year mark. Property is performing well, and Frank's going to get into how well it's performing, what challenges there are in place, how we're solving them, and then again, what the capital event status looks like. If you have any questions that aren't addressed, feel free to reply to the email and we'll be happy to answer them. So with that, I'll turn it over to Frank.
Thank you, Joe, and thank you to those investors joining us on this call. I'm going to provide a detailed update on operations, and then I'll provide an update on when we might expect to see a capital event on Westmoor in light of the fact that we're approaching our 5-year anniversary. Westmoor, though located in a somewhat challenging submarket, continues to perform well for us. Distributions are strong at 8% per year, and occupancy is currently 92.8% and projected to be 95.7% in 14 days from today. So demand at the property remains strong. One issue at Westmoor is bad debt write-offs. The eviction process for this property in this submarket takes much longer than other assets due to stipulations surrounding agency loans that cause us to have to wait 30 days to file for an eviction versus the 3 days at properties without agency loans. Agency loans must abide by the CARES Act, which is implemented by the government, and Freddie and Fannie Mac are government loans. This, combined with county court staffing issues, has caused the eviction process to go from an average of about 4 to 6 weeks to 3 to 6 months in certain cases. But to combat this, we've implemented a software called Snapped. It's a fraud detection program, and we use it as part of our screening process to avoid leasing to prospects who cannot afford to pay rent. As a result of this, our current collections are 91%. We are continuing to clean up the rent roll and bring in more qualified prospects to this property. But in spite of these collection issues, our cash flow remains strong. Due to our tight expense management and the fixed rate debt that we currently have on this property, over the past 5 years, including the supplemental loan, we've been able to return just over 62% of the invested equity back to investors. As mentioned, we're continuing to distribute 8% per year. So let's talk about when we might expect to see a capital event. Though we would like to sell sooner than later, we're faced with 2 issues, the lesser of which is the bad debt that's impacting revenue. It's never ideal to sell a property with higher than normal bad debt. However, this is not a major issue, and based on where the property is located, this is not uncommon for assets within this submarket, so buyers won't be surprised by that. The larger issue is really just the timing of the real estate cycle that we're in. Cap rates have expanded roughly 150 basis points over the past year, causing values to fall. Based on this, the market is weak, and it's less than ideal to sell into a weak market. Unfortunately, our cash flow is protected by the fixed debt, so we have time to wait for a stronger market. And we'll continue to look at the market, and we will seek a disposition as soon as we feel we can achieve a strong return for our investors. And in the meantime, we'll continue to distribute a strong return. And with that, I'll turn it back over to Joe.
Thanks, Frank. And thanks, everyone, for your partnership on this deal. And if you have any additional questions, feel free to, as I mentioned earlier, just reply to the email and we'll be happy to answer them. With that, again, grateful and have a wonderful evening.